Hi, welcome to Christensen Wealth Management. I'm Michael Christensen, and thank you for taking time out of your day to watch this weekly stock market update for the week ending Friday, November 2nd, 2018. Before I jump into the charts and commentary, I would like to begin with the quote of the week. And this week's quote is from H. Norman Schwarzkopf, and you may remember him as Stormin' Norman from the U.S. Gulf War. In the Persian Gulf, he was the general of the U.S. Army and the leader of the coalition forces back then. He once said, "You can't help someone get up a hill without getting closer to the top yourself." Those are some wise words from Norman Schwarzkopf. Anyway, the market has continued its crazy volatility. We had a little bit more of a sell-off earlier this week, followed by a 3-day rally at the moment. Question is the rally for real or is it just a bounce? The charts are telling me it's just a bounce, and you should use any rally to reduce risk in your investment portfolios. Many of the charts have extreme technical damage that shows the possibility of further weakness and decline to come. So again, just use caution going into November here, and we'll see where we go over the next 7 days between now and my next video. And there's one thing that I want to follow up on regarding last week's video. Last week I showed you the smart money flows, and here is the chart for this week's smart money flow index. As I said in last week's video, the Smart Money Flow Index measures the behavior of smart investors. Those smart investors are usually institutions or other skilled investors that know what they're doing, and they do not trade their investments during the first hour of trading every day. They tend to do all their trading after the first hour. So if you take out the behavior of the first hour of trading and measure the remaining hours every day, you get a sense of what the smart money flow investors are doing with their money. And you can see in this chart that the smart money is leaving the stock market at a record speed and even continuing to the downside following last week's chart that I posted. So this to me says remain very cautious, because you can see the Dow Jones Industrial Average in green going all the way back to 1990. The Dow usually rises when the smart money flow rises, and the Dow usually falls when the smart money flow falls. So be very careful going into the month of November. In addition to that chart of the smart money flows looking rather bearish, I feel it's important to say that in the month of October, which we just put an end to, the global stock market value, the value of all global stocks combined, declined by $8 trillion last month. That is a pretty substantial amount of money. And also the NASDAQ 100 stock index had its worst month since October of 2008. And if you know what happened in October of 2008, it wasn't a very good month for the U.S. stock market. So that is another reason to be pretty cautious. And the S&P 500 last month had its worst month since February of 2009. And that also was a very difficult month for the U.S. stock market. So there are lots of signals out there saying to be careful with your money. But there is much more to say, and I'd like to cover that on the charts. So let's go ahead and jump in, beginning with the Dow Jones Industrial Average. Looking at this chart of the Dow Jones Industrial Average from November 1st, 2017 until November 1st, 2018, you can see the last 12 months have been extremely chaotic. That is a crazy looking chart with a lot of volatility. But as you can see here, this right there was approximately when I did my last video, this little bounce here. And then we dropped and made a low into October 29th. And on the 30th, 31st, and the 1st of November here, we've had a nice little bounce in the Dow Jones Industrial Average. Let's quickly look at the indicators. The 5-day moving average in red is below the 20-day moving average in blue, indicating that in the short-term time frame, meaning pretty much days of time, the Dow Jones is definitely weak. Those lines crossed back here on October 9th, and that has been pretty much a straight line road downward. Now, when we look at the bounce here, you can see that we bounced up and touched the 50-day moving average. If I switch this over to a candlestick chart briefly, you can see, if you look very closely, that is, the high of the day so far on November 1st was, let's see, 25,364, and the 50-day moving average is 25,373. So we came up and just a few points shy, but we did not break the 50-day moving average. So as of right now, the 50-day moving average is providing resistance for today, that is. Now, the other resistance that let me go ahead and finish the intermediate term indicators, which is a time frame that represents strength and weakness over a period of weeks. You can see that the 20-day moving average in blue has broken below the 50-day moving average in purple, so we officially have much weakness on the intermediate term time frame. So that also is not a bullish sign. Let me go ahead and clear those off the screen and show you where the other resistance exists on the Dow Jones chart. And what you should see is this high right here, which is June 11th, is one area of resistance that we broke, and you can see that we are currently under that. And we had 3 different highs there. We had a high right there on February 16th, a high there March 12th, and then another one on June 11th. So right now we are just below that line, but between the 50-day moving average and these prior 3 highs earlier this year, those all line up to be some pretty significant resistance, and we need to see the Dow Jones break above that if it's going to go back to all-time highs. So just remain cautious as long as that short-term indicator, the 5 and the 20-day moving averages, are still in the weakness confirmation. Wait for that to change to a strength before we start to think everything is getting better. Here is the chart of the S&P 500 stock index, and it too is having a bounce the last 3 days, and you can see that we are still all the way back where we were on January 4th. So we haven't made a whole lot of progress in the last week since we did make a lower low on October 29th before the bounce. But right now, the 5-day moving average in red is below the 20-day moving average in blue, indicating in the short term, that is days, we have much weakness in the S&P 500. And in the intermediate term, we have the 20-day moving average in blue is well below the 50-day moving average in purple, indicating that in the intermediate term, meaning weeks, the S&P 500 is showing much weakness as well. So use caution here with the S&P 500, and I'd like to go ahead and zoom out and show you the broken trend line that exists going back quite a ways. And we'll start right here at this point on February 10th of 2016, and I will draw that trend line in for you right there. This was the bullish trend that had existed for the last 2 years, or 2 years and 8 months, or something like that. You can see that we started, we touched it at making a second point October 2nd of 2016. We touched it a third time on April 3rd, 2018, and we came down and we broke that 2 year, 8 month trend line in October, on about October 11th, 2018, bounced up one last time and then dropped. So this is a problem for the S&P 500 because the trend that has been our friend for over 2.5 years is now broken. So much caution to be had there. In this chart, which is just the S&P 500 zoomed out a little farther, all the way back to the end of 2008, you can see the low that was made back here in March, about March 5th, 2009, before the big bull market run we've had. I'm showing you this chart because it may represent where the S&P 500 is headed if this stock market continues to sell off over the next several months. Take a look, if I draw a line here from the lows of March 2009 all the way up and connecting with this low right there of February of 2016, and draw that on up there. We'll put it right there. You can see that the trend line has 3 points, and the first one was that low of March 2009. The second one was right here, September 2011. Oh, didn't mean to do that. And then the next one was right here, February of 2016. And you can see that once we got past February of 2016, the stock market, or the S&P 500, took off on a whole new rate of speed to the upside here. And now that that is broken, the S&P 500 may continue to fall until it gets down to this bottom red line here. I'll go ahead and delete this one so there's no confusion. So we may have a sell-off of the S&P down to this red line here in order to create the fourth point of this 9-year trend line, or whatever it is. And that would mean that the S&P 500 would go from 2,736 down to about around 2,313, and in percentage terms, that could be, that would be about, let me just check the calculator here, that would be 15.4% approximately, or just say 15%. So if the S&P 500 keeps selling off, we may have an additional 15% decline over the next several months to get down and make the fourth point on this long-term bullish trend line. So that is another sign to remain extremely cautious when considering the outcome of the S&P 500 going forward. Here is the chart of the NASDAQ Composite Stock Index going back to November 1st, 2017 until November 1st, 2018. You can see that we've had a little rally here the last 3 days or so, and the NASDAQ is still where it was price-wise back on January 22nd. So it's still been hit pretty substantially in the month of October. As I said, it was the worst month of since October of 2008. So it was a pretty rough month for the NASDAQ, which is full of growth stocks and technology stocks. The 5-day moving average in red is well below the 20-day moving average in blue, indicating significant short-term weakness in a daily time frame. And if I switch it over and look at the 20-day moving average in blue, is below, significantly below, the 50-day moving average in purple, indicating much weakness on a period best measured in weeks, not days. So that is even more bearish than the daily. And a couple of things to bring to your attention is that as of the recording of this video, it appears that the NASDAQ, let me switch it over to a candlestick chart. The high of the day right now, as of the middle of the day on November 1st, the high of the day went up and just touched the 20-day moving average in blue and then backed off. So right now, the 20-day moving average is acting as resistance, for the NASDAQ, but there's also one more thing that is important to show you. This low right here on June 27th is another resistance line, another point of resistance that, interestingly enough, coincides perfectly with the 20-day moving average in blue. So we have the exact same point right here as well on February 26th, and we have that low there, June 27th, and it lines up. So we have all kinds of, we have basically three different areas of significant resistance for the NASDAQ, so it's going to have a very difficult time getting above the 20-day moving average and getting above these other points here. So we just need to take it one day at a time, but right now it looks like more of a bounce has happened the last few days in the NASDAQ rather than a full turnaround in this index. So use caution until at least the 5-day moving average starts to head up above the 20-day moving average, at which point that'll be an improvement, and we'll look at it again then. If I zoom out on this chart of the NASDAQ Composite Stock Index to have the beginning date as of May 2008, you can see this little drop here on this chart at the very beginning. Believe it or not, that was actually a 50% drop in the NASDAQ Composite Stock Index from May 12th, 2008 to the low of March 2nd, 2009. And it's amazing how small that looks compared to where the NASDAQ has gone the last 9 years. But what I want you to see is where the current trend lines are, what has been broken, and where the NASDAQ may be headed. I'm going to go ahead and draw this trend line here, which is the most recent trend that began on February 8th, 2016. And we had a touch here, and a touch here, and a touch here, and a touch here. So that's 1, 2, 3, 4, 5 touches. And then one more up here, April of 2018. And you can see in October of this year, that trend line was broken. That goes back basically 2.5 years, a little more than 2.5 years of bullish trend broken for the NASDAQ. And if the NASDAQ does turn into another bear market and keeps falling in the next few months to year, well, here, if I connect the low of 2009 and draw that up there, you can see that this trend line also has acted as support for a much longer time frame, with touches in 2011 in August and September of 2011, as well as November of 2011, May of 2012, November of 2012, December 2012, and then a long bounce, and then another touch right here on February of 2016, before the NASDAQ went into overdrive and took off like a rocket at a much faster rate of speed. So, in conclusion, what I'm going to say is, if the NASDAQ keeps falling because this trend line is broken, that would take the NASDAQ from 7,415, where it is as of the recording of this video, down here to about 5,675. So let's go ahead and do the math on that just for curiosity. 5,675, and it's currently at 7,415. That's 1,740 points divided by 7,415. That would be a 23.4% drop for the NASDAQ, if the NASDAQ Composite, that is, if it continues falling all the way down to this long-term bullish trend line. So that would not be a good thing for the NASDAQ Composite. That would make investors very worried. So I'll wrap it up with this chart and just say be very cautious, especially with the NASDAQ Composite ending 2018 and going into 2019. Thank you again for watching this market update. Before you go, please do me a favor and click the subscribe button on this YouTube channel if you have not already, and then click the little bell next to it so you'll be notified whenever additional videos are posted by me. And in the top right-hand corner of christensenwealth.com and in the summary description of the video, you will find links to the Facebook, LinkedIn, and Twitter pages for Christensen Wealth Management. Please visit those pages when you can and like or follow them while you are there. Well, have a great day, a great week, a very enjoyable month of November, and I look forward to seeing you again in about another 7 days. And with all the craziness going on, just remain cautious and pay attention to the markets and your money. And as my friend says, getting back to even is not an investment strategy. So try to protect what you've worked so hard to accumulate. Have a great day. Bye-bye.